All right, let's cut through the daily market noise. Forget the algorithmic chatter and the talking heads on financial TV for a minute. Today, in this explainer, we are stripping all of that away to look at the fundamental, mechanical plumbing of the economy, credit expansion, and interest rates. As institutional investors, you're constantly evaluating risk, right? But the truth is, true systemic risk usually hides right in the basic pipes of our financial system. So let's pop the hood on this macro engine and see how it really works.
Here's our roadmap for the briefing today. We'll start with the credit creation engine, decode some bank balance sheets, look at the mechanics of the multiplier effect, and see how interest rates dictate investment. Then we'll pivot to savings behavior and wrap up with a fascinating behavioral glitch called the paradox of thrift.
Okay, first up, the credit creation engine.
Now, you really have to wrap your head around this core paradox. We tend to look at an individual commercial bank and obsess over its specific lending choices. But an individual bank is literally just a single pipe. It just passes the water along. It absolutely cannot create money out of thin air on its own. All it can do is lend out its excess reserves. But the banking system as a collective whole, that is the entire municipal reservoir and pump station. Together, through successive waves of lending, the system creates pressure and flow essentially out of nowhere.
Moving on to part 2, decoding bank balance sheets.
To actually prove this mechanical process and to really assess how banks manage liquidity risk, we have to look strictly at the ledger. If you were to pull up JP Morgan or Bank of America's 10K right now, you would see this exact physical separation. On one side, their funding sources, which are their liabilities. On the other side, what they actually do with those funds, their assets. As a business analyst, making this distinction is absolutely crucial to understanding how systemic credit expands.
And here's the golden rule of bank analysis, and it's kind of counterintuitive. A customer deposit is an asset to you, but to the bank, it is a strict liability. It's a funding source they eventually have to pay back. It's their assets that dictate true lending power. And I'm not just talking about vault cash. Vault cash is essentially just the change in the cash register to handle daily withdrawals. The real systemic vault is their demand deposits held at the central bank. Those central reserves are what balance against customer liabilities and actually fund their massive loan portfolios.
Section 3, the multiplier effect mechanics. Let's see how this actually plays out. So, here's the absolute proof in the math. Assuming a willing borrowing public, let's say the central bank mandates a 20% reserve ratio. Someone deposits a primary sum of $1,000 into Bank 1. The bank holds 20%, $200 in reserve, and lends out the $800 of excess. Whoever borrowed that $800 spends it, and it inevitably gets deposited into Bank 2. Bank 2 holds 20%, $160, and lends out $640. That hits Bank 3, which holds $128 and lends $512. $800, $640, $512. The money just rapidly expands through the system like a chain reaction. For the quant modelers listening, we define this cycle as the credit multiplier. It's actually a super simple mathematical formula that governs the total secondary expansion. You literally just divide 1 by the reserve ratio, and boom, you have the ultimate indicator of the final change in bank deposits that will originate from that single initial deposit.
So, if we apply our formula to that 20% reserve ratio, 1 divided by 0.2 gives us a multiplier of 5. Apply that multiplier of 5 to our primary $1,000 deposit, and we witness the total money supply expand to $5,000. Think about that. That's a massive secondary credit creation of $4,000, completely born from the initial deposit. This exact secondary creation is what fueled the historic long-term credit cycles we saw, pumping up the economy right before 2008.
Section 4, interest rates and investment. Now that we know how the credit engine works, we have to look at the pedals, the brakes, and the accelerator. At its core, interest is basically just the prevailing price tag on corporate debt appetite and the premium placed on holding on to capital. We watch this metric like a hawk because the total level of investment in an economy is incredibly sensitive to even minor changes in these rates. Let's use the post-2008 zero interest rate policy era as a case study. Money was practically free. Borrowing costs hit rock bottom, so firms eagerly tapped into that credit multiplier to fund massive tech expansions and huge infrastructure projects. They were weighing negligible debt costs against massive potential returns. It acted as an absolute supercharger for economic growth.
But conversely, look at what happened with the aggressive rate hikes in 2022 and 2023. Central banks slammed on the brakes. The cost of loans surged. Suddenly, corporate expansion plans were shelved, borrower confidence plummeted, and systemic growth cooled fast as liquidity tightened up. Under those conditions, banks totally change their lending strategies, and overall investment drops because firms just won't take on expensive new debt projects.
Part 5, Savings Behavior and Effects. And here's where it gets interesting, because it's not just corporate debt that reacts to these rates.
Interest rates fundamentally alter consumer behavior, which trickles right up to your institutional portfolios. We look at two distinct behavioral reactions. First, the substitution effect. When rates are low, your savings account pays you basically nothing, so your incentive is to substitute saving for spending. But contrast that with the income effect. Lower rates mean heavily reduced income from fixed-yield savings. This actually forces cautious people, especially those trying to hit retirement goals, to hoard even more cash just to hit their target numbers.
Which brings us to a massive counterintuitive systemic risk question. We are totally conditioned to believe that saving money is always a good thing, but macroeconomically speaking, is it actually possible that saving too much capital destroys the machine?
And that brings us to our final section, the paradox of thrift.
Here is the crucial point. If every household simultaneously decides to act prudently and hoard their cash, overall consumption falls off a cliff. And because my spending equals your income, this sudden drop in demand literally starves businesses of revenue. No sales leads to liquidation. Liquidation leads to layoffs. Layoffs lead to rising unemployment. It's a vicious cycle.
So, an attempt by the whole economy to increase savings actually fails to increase total savings in the long run? Instead, it lowers overall aggregate output, income, and employment. It's a bizarre glitch in human behavior, where what is an absolute virtue for an individual household acts as a toxic vice for the broader economy. It stops the very process of income generation we need for long-term growth.
Look at this quote. It really hits the nail on the head. Saving is treated as a virtue by households as they provide a protective umbrella, but the same is treated as a vice by the economy as it hinders the process of income generation. This is exactly why you, as portfolio managers, have to look way past individual financial prudence. The credit creation engine literally requires consumption and borrowing to keep running. If the public entirely shuts their wallets, the multiplier just breaks down. So we'll leave you with this stark reality. Systemic liquidity risk isn't just about bank reserve ratios or central bank policy adjustments. It's deeply, fundamentally behavioral. When you're modeling risk, you have to ask yourself, will the collective, defensive savings behaviors of the market ultimately contract the exact systemic engine you're relying on for your long-term capital growth?